If you've been watching the news lately, you probably think the world is ending. It feels like every day there's a new headline about tariffs on Europe, rising geopolitical tensions, or some bizarre political drama. It's enough to make anyone want to sell everything and hide their money under a mattress. But here's the strange part. Take a look at the S&P 500. It's bending, but it's refusing to break. Why is that? It's simple. The liquidity cycle is completely overpowering the news cycle right now. What we are seeing is a classic wall of worry in action. The market is climbing, even though everyone is scared. Let me introduce you to what I'm calling the June peak theory. I believe we are in the middle of a final, powerful rally that will be driven by the anticipated Fed rate cuts in March and June. This rally will likely last for the next 6 months, before the real economic drag from all this chaos finally catches up with us later in the year. So, the question isn't whether the world is ending, but how to navigate the very specific market environment we are in right now. Now, let us talk about the so-called wall of worry versus the real driver of this market, AI capex. When we see headlines about tariffs, it's easy to panic. But seasoned traders know that markets often treat this kind of political noise as just that, noise. They're seen as bargaining chips in a larger negotiation, not permanent economic policy. The market tends to look past the immediate drama. So, if it's not the news, what's actually holding the market up? The real engine is the massive, almost unprecedented investment into AI infrastructure. The IMF recently projected global growth at 3.3%, and a huge chunk of that is being driven by the AI build-out. We've moved past the initial hype of AI software and into the hard asset phase. Think about it. We are talking about building new energy grids to power it all, constructing massive data centers, and sourcing physical commodities like copper. This isn't just about a few tech companies. It's a fundamental, physical transformation of our infrastructure. This massive capital expenditure is creating a very high floor under the market, preventing the kind of collapse the headlines seem to be predicting. The biggest catalyst for this June peak rally is the Federal Reserve. The market is already pricing in rate cuts for March and June. Historically, this is the sweet spot. Markets tend to rally strongly into the first few rate cuts, as investors anticipate cheaper money and a friendlier economic environment. The actual sell-off often happens after the cutting cycle is complete, not before. And here's something interesting. This rally probably won't just be about big tech. Lower interest rates are like a lifeline for the sectors that have been absolutely crushed for the past 3 years. I'm talking about small caps, real estate, and other unloved parts of the market. As rates come down, these sectors could start to perform well again, creating a much broader, healthier-looking rally. This is the kind of rally that tends to suck skeptical retail investors back in, pushing prices even higher into that June peak. But what happens after June? This is where the risk comes in. By the third quarter, around July or August, the party could be over. We'll start to feel the hangover. The real economic costs of tariffs, like higher inflation and lower consumer spending, will finally start to show up in corporate earnings reports. The stimulus from the rate cuts will have been priced in, and the underlying economic reality will take center stage. The biggest risk is that the Fed cuts too late or not aggressively enough to stave off a slowdown. By late summer, the dominant narrative could shift from rate cut rally to impending recession. The same news headlines that the market is ignoring now could suddenly start to matter a whole lot more when earnings begin to disappoint. So, what's the actionable takeaway here? How do you trade this? First, don't panic sell every time a negative headline drops. The market has shown it can absorb a lot of bad news for now. But at the same time, don't FOMO buy into the peaks, especially as we get closer to that June timeline. This is not the time to be chasing speculative, high-flying stocks with no earnings. Instead, focus on what I call defensive growth. Look for companies in sectors like healthcare or, more importantly, the AI infrastructure space we talked about, the companies building the data centers, providing the energy, and supplying the raw materials. These are businesses with real demand and tangible assets that should hold up better in a volatile environment. So, let me know what you think. Are you holding cash and waiting for the crash, or are you riding this wave until June? Drop your strategy in the comments below. Thanks for watching, and don't forget to subscribe for more insights.